So, what is inducement? Now, inducement is a consolidation part or an opposing candle of a downtrend or an uptrend that often lures the trader, especially smart money traders, to enter trades. And this is exactly when they fall for the trap. So let's look at this thing that we're seeing in this thing. Now, most of these three things are smart money concepts, right? And we already talked about order block. We already talked about liquidity. In this video, we're going to talk about inducement. Now, the word inducement is just a fancy word for a trap, a bear trap, a bull trap. In this case, this is a bear trap. So let's look at the chart right now. Typically, we have the order block, right? If you know about smart money concepts, you know that this is an order block. Very clearly, this is an order block. And then we have a consolidation part. And this one becomes the liquidity. These areas becomes liquidity. Now, what is liquidity in simple term? Liquidity is where money lies, and money lies where people put their stop loss. Okay, so let's remove these very messy drawings and let's get right into the main topic in here. Why is there inducement? Because when people put their stop loss here, who do you think are trading this? Smart money concepts traders, mostly MACDs and smart money concept traders, even EMA traders. Because one thing about EMAs is they often produce fake signals. The EMA could do this, and then most people would look at the EMA and they're looking for shorts, or smart money concepts looking for order blocks. So they place a short at the order block. They call it so-called order block, okay? And so they put their stop loss exactly here. Now, what happens when many traders does the same thing? Do you think the market will reward these people? Now you have to think a market in terms of efficiency. When someone makes money, the other person loses money. When the other person loses money, the other person makes money. Trading is a no sum game. There is no mercy in this. So when people put stop loss here, what do you think the market will do? Let them take their profit? No. So what they'll do is they put a stop, they put it just a very basic order block entry, and they see the price coming up here and they touch the entry. And so they're very confident. Oh, look at it. The price touched my entry, right? And so the price retraces a little bit. Now, why do you think the price retraces a little bit? Typically, when most traders get filled at the order block, they usually retrace a little bit. Why? Because certain traders, they usually look at the market and they're feeling like, okay, I don't want to enter first. I want to wait for a confirmation. So most people will wait for the trade to enter, and then when they get this little drop, most traders would panic and enter a short because they call it somewhat a reaction. They think that the market have reacted. Okay, but typically this is not. This is another trap above another trap. So there are many inducement in one single trade. So you have to be very careful. There are bear traps, bull traps everywhere. So you have to be careful where you step on. So, and then the price shoots up immediately, taking out their stop loss immediately. You can see most people will have the stop loss here. Nobody is going to put their stop loss all the way up here. Okay, in the long run, you might think they're not going to get stopped out. No, this is a negative risk reward ratio trade. They will not be profitable with anything like this in the long term. They will never be. So once they get stopped out, they're very pissed. And so they think the market is now bullish because they think they broke structure. They say, oh, this is the lower high and now it broke structure. So they think this is the head and shoulder because they think they broke this thing and they were gonna go up. So what they're seeing here is the same thing. They think the market has a break and shoulder and it's going to go higher. So what are the same traders are going to do here? Same traders are going to do exactly the same thing when the market is going up and here what they're going to do is they're going to take the longs here. They're going to put the entries here. And the market is kind enough to go down a little bit. And so the traders panic and so they enter a long. Okay? Now, what do you think will happen here? This is a little quiz here. What do you think will happen here? What do you think will happen here if they place a long here? So the price goes up a little bit in their favor. Now, why did the price go up a little bit? Why did the price go up a bit? Let's say that they put their stop loss here and they're targeting all the way higher. Why do you think the price went up a little bit? The same logic that we had when we were here. Why did we go down a little bit? Because we want to induce, to lure more traders into entering long. So now more traders are entering long here. And so they put their long position here and they put their stop loss here. And more traders are becoming the food. Okay. And this one becomes another level of inducement because this is where people put their stop loss. And so the price comes all the way down, breaks their stop loss, retraces a little bit, and then breaks everyone's stop loss and goes down and takes out all the stop loss. Okay, but as smart traders, we see this very easily. When we look at the market in fractals, in fragments, in fractals, that we can clearly see that this was the first inducement. This was the prior inducement that was inducing traders. So whatever we see here is just noise. So before you are able to start or even have a good trade in the first place, you have to be able to spot the prior, the first inducement, the very first inducement that trapped the traders. You need to understand where the market direction is going. Now, in forex charts, we would usually see this as a downtrend. It's a very clear downtrend. That is why people say the trend is your friend. Do not trade against the trend unless you have a clear, definitive change. But this is not a change. This is inducement. So when there are two order blocks, this is not called order block. This is like order block, whereas this is real order block. Whenever we have stuff like that, you want to place your entry like this. So you put your entry like this. This is the way to do it. Now, of course, there is no guarantee that your trade will play out well. There are times where you are going to get stopped out, and that's just fine. But in the long run, if you're playing the right strategy, this is going to go in your favor. More often than not, once the market takes the stop loss of many people, it usually goes to the next point of liquidity, which is here. This is the next point of liquidity. This is the point of liquidity of certain swing traders and traders. So this is where you want to look at. So enough talking about theories, and let's get right into the charts. So here I prepared you multiple examples. This is I picked some of the good examples, and then we can look at the charts together live. We're not gonna cherry pick anything. We're gonna look exactly where these inducements can be found in the chart, and I assure you they are everywhere in the chart. So if you miss one inducement, don't be afraid and say, "Oh my God, I'm gonna wait another week for this." No, it happens almost every 2 days, 3 days, depending on your time frame. If you're on the 5 minute, it happens almost every single day, multiple times a day. So don't be afraid of missing out anything. It happens every single day. Okay, you're going to have unlimited opportunities. So, example number one, we first have a clear downtrend. We have to use the rule. Okay, so my rule for you is that use this three-step rule. The first rule is identify the trend. What trend are you in? Are you in an uptrend or are you in a downtrend? If you're in a downtrend, do not even bother looking for longs. It's clear as that. And you might say, well, what if there is a reversal? Okay, well, let me show you something in this chart. What do you think is here? What do you see here? What is this? This is a really, really bearish market. How many traders thought that this was the bottom, 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 until they found actual bottom? How many trades have their stop loss got hit, triggered? How many times did that happen before they actually got the bottom? This is the question you have to ask yourself. You are playing a numbers game. You are playing a numbers game. What are the chances of your trade succeeding? When the market is in a downtrend, it has a 90% to 95% of chance continuing lower, whereas it has a very slim chance of reversal. So you are betting on that 5 to 10% on the reversal when you could have taken multiple win trades by simply going with the trend. And how hard is it to identify the trend? How hard is it to identify this thing? How hard is it? Are we not in a clear downtrend? This is clear. This is very clear. This is not confusing. This is not very weird. This is not very hard. You don't have to use tools. You don't have to use trend lines. You can look at this chart right now and say it is a downtrend. It's a very definitive answer. It is not subjective. Certain trading things are subjective, but this is not subjective. This is a clear downtrend. Anyone that says this is an uptrend is weird. It is funny. Okay, it's laughable. This is a downtrend. This is no way to be debatable. So now that we have a clear, definitive answer of what trend we are in, we are looking for shorts. So do not bother trying to look for longs here. As you can see, we got stopped out. Don't bother looking for longs here. Don't bother looking for longs here. You are going to get stopped out 100 million times and you're going to be very pissed about it. And this has happened. So look for shorts. Okay, once you identify it is a downtrend and you're looking for shorts, what is the next step? The next step is identifying the order block. So when you are in a 4-hour trend, you want to look at the zone that you want to trade. Let's say you want to trade at this zone. This is example one, right? So where is the order block? The order block could be here, the order block could be here, and the order block could be here. So how many of them is reliable? Now, once you draw a little box on where you want to look at, you want to draw all the possible order blocks. Okay, so now that I have three order blocks here, 1 and 2 and 3. So the 2 is actually this gray box, and my third one is actually this entire little inducement area. So what happens here? Earlier we talked about the same theory down here. What do we see here? We have a order block forming, and then we have a drop, and then another order block forming here. Okay, and we came down. What do you think will happen here? What do you think will happen here? Oh, it's very clear. The market literally showed you. So what did I say earlier? So let's look at the charts directly here. Let's look at the order block. The order block. The price actually, so many people are trading this and they're shorting this asset because they see an order block, so-called order block. So what do you think happened? They got stopped out immediately. Why do you think they got stopped out? Because first they got in the trade. The market first triggers their trade and then goes a little bit. Why did it go down a little bit? Because they want to lose a little bit. And so it lures more and more traders into shorting it. So when it has accumulated enough traders, it will immediately and break up the zone, becomes the inducement. This entire zone is an inducement. Inducement is a trap. So once people got lured, this is the real order block. What are you looking at here? You're looking at a short and you're looking at the real order block that you're shorting. You're shorting at an order block right above the inducement. So where is your target? You could target the point of liquidity. Now, if you are a bit more advanced, you can go to the weekly, the monthly to look for lower zones that you could target as zones. But for the sake of this video, we're just going to use the closest point of liquidity. So this was the order block. And you might argue, what if the price continues higher? Okay, sure. Then we look at this order block and we look for a short here. Okay, so eventually, if you have a high risk reward ratio, you don't have to worry about losing multiple trades because one trade is going to gain you all the profit backs with extra net profit. So this is something that you have to pay attention about. Risk reward ratio matters. So let's revise about what is the three-step method. Step 1, identify the trend. Are you in an uptrend or a downtrend? This is a very definitive answer. You don't need second opinions on this. Step 2, draw out a little zone on where you want to trade and draw out all the possible order blocks. And then third step, find the inducement and then trade the order block. Okay? And you also want to monitor the price movement. If it acts in a certain way, then you can use your intuition, your experience in trading to kind of tell. But if you do not have if you do not have the experience, simply follow these 3 rules. So example number 2, are we in a downtrend or an uptrend? Downtrend, we don't have to change anything. We're still in downtrend. What is the zone we want to trade in? After the price has taken out the liquidity here, we want to look for the next zone. So here, this becomes the zone that we want to trade. So what do we have here? We have order block number 1. Sorry, this is order block number 1, and this is order block number 2. So this is order block number 3. Okay, it's tiny, but if you go to the daily, you would be able to see clearly this is an order block. So once you have this, what do you think the price did? Okay, so let's just draw it out for visual purposes so you can see it very clearly. Let's draw it out, and clearly the price touched the order block. Can you see this little white candle here? Let's just zoom it in a little bit. Can you see this little white doji candle? This is an allure to trap traders to short again. And then it pushes high and breaks all their inducement. And then the price spikes up once more to grab the inducement up here and then touch the potent order block. Once the order block number 2 has been touched, just wait. You can see an immediate drop in price. So how could we trade this thing? We could easily enter a trade here and put a stop loss up here, up here, up here. It's your choice, depending on how confident you are in the trade. If you don't want to think too much, if you don't want to overthink, just put a stop loss here. If you want to be precise, you could do something like this, and you could target here. A 1 to 3.6 is a very tasty trade opportunity. Okay? The 3-step procedure. What are we in? We are in a downtrend. So what time are we trading? We're trading here. So what are the order blocks? Order block number 1, order block number 2. What happened here? The price touches the inducement here and then touches into this order block number 2. Once it has grabbed the inducement of order block number 1, this is order block number 1, this is number 2. Once it has grabbed the inducement up this wick here, the price immediately goes down and touches the order block number 2. Once order block number 2 has been breached, we immediately go down and grab the liquidity down here. Now this is the catch here. Most traders here would take their profit at the bottom of this wick, but this is exactly when the market reverses. Now, is this something you have to be concerned about? No, because you are going to have 10 win trades and 1 losing trade because of this inducement. So how I advise most traders to do is, don't worry, clearly you took many wins up here, here. One loss is not going to be big. A little way you can counter this is that now that you have a order block that you have entered, let's say you entered here, okay? There's 2 ways you can do this. Number 1 is when you have a take profit here. Number 1 is once the price touches these zones, you want to take partials. So 50% off, 20% off, 50% off. So you can take partials along the way. So if the market ever reverses back and touches your stop loss, you are going to be in profit. If you do not want to do that, you can simply keep your stop loss and your take profit, but you want to move your stop loss to break even. So when the price touches your stop loss, you are not going to make a loss. You are not going to make a loss. Maybe you might want to do it a little lower so you can actually cover the trading fees. But this is the same. You're not going to make any losses, not any significant losses. Okay, so this is it for this video. I hope you took something out of it. Inducement happens everywhere in the chart and it's in every single corner. You have to master this in order to trade. Just because you learn on the block doesn't mean that you're pro. Everyone can learn everyone can watch a YouTube video and learn about what order blocks are. What makes you special is how you understand the charts and how you interpret the chart. In this channel, I focus very much on the logic of every single trade. You do not want to take a trade because you feel like it. You want to take a trade because you understand the reason, the logical reasoning behind the trade. Okay? So thank you for watching. I hope to see you in the next video. If you have any feedbacks you want to know, please leave a comment in the comment section, and please consider liking and subscribing to this channel if you find this video useful. Thank you for watching and see you in the next video.